Disable screen sharing. Okay, good morning, everyone. I want to believe that all of you can hear me. Can you hear me? Okay, you're all welcome to this training session, which is on financial planning and bookkeeping. It is expected at the end of this training session of financial planning and bookkeeping, you, the participants, should be able to, one, understand what we mean by financial planning activities, so that when we talk about financial planning activities, you understand what we're referring to. Secondly, you should be able to differentiate long-term from short-term financial plans. Thirdly, understand reasons for bookkeeping, the main reasons why companies, entities, individuals maintain their financial records and bookkeeping. Fourthly, identify bookkeeping methods available to individuals and corporate entities. And fifthly, record financial transactions. You should be able to record financial transactions, either as a bookkeeper or as an entrepreneur. Then finally, we see how we can balance the books. But the act of balancing the books comes with some degree of experience. So we'll just see how far we can go with it, bearing in mind that most of us do not have accounting knowledge or background. Let me start off by telling you this adage. You can't run a healthy, successful business without having your books in order. It's not possible for your business to thrive efficiently, successfully, if your financial records are in a mess. It's practically impossible. Any attempt to do that, you will be likened to a man who drives a car without a fuel gauge or a map. Sooner or later, you are going to run out of gas. And you can all tell what happens when somebody runs out of gas. When you run out of gas, out of fuel, your car will be forced to stop. And once the car is stopped, the car will be towed away or pushed aside. This same analogy applies to businesses. Excuse me. We are saying that you cannot run a healthy and successful business if your financial records are not in place. And if you fail to plan your financial activities, you will definitely have problems with the business. And that's the whole essence of this training session, so that we all understand what is meant by financial planning activities and how best we can maintain our financial records, our bookkeeping records. Let's start off by looking at financial planning. Financial planning is a plan needed for estimating the fund requirements of a business, determining the sources for the same. So any plan that is needed to estimate how much fund, how much in terms of naira and kobo that is needed for a business to thrive, and having identified how much is needed for the business to thrive, you also seek to determine the source in terms of where the money will be gotten from, where the funding will be gotten from. These whole activities is what we refer to as financial planning activities. Most of us already have our proposed businesses, the business that we want to engage in. It is also very important that you identify how much that will be needed for that proposed business to be set up. It is also very important that you identify where the funding will be gotten from. That's the source of the fund. Like most of us already have identified the source of our funding, which is NISA Microfinance Bank. Quite all right. It is also very important that you estimate or identify when these funds will be needed for injection into the proposed business. So all of these planning activities, trying to estimate how much in terms of naira and kobo that is needed for the business to thrive, where the money will be gotten from, and the timing for the fund to be deployed into the business is what we refer to as financial planning. So financial planning essentially includes generating a financial blueprint for companies' future activities. Very important. Generating a financial blueprint for your company's future activities. In other words, you are trying to design the future finances of your company such that the company can thrive efficiently. The company's operations can thrive effectively. That's what we refer to as financial planning. Here are some of the objectives of financial planning, the main reasons why individuals, companies, entrepreneurs engage in financial planning activities. Number one is to ensure availability of funds. When you plan your finances, you are basically ensuring that funds are available for the proposed business, because funding is very critical in terms of business operation. For you to convert that dream into reality, you have to ensure that funds are available. And that's the more reason why you have to engage in financial planning activities. Secondly, estimating the time and source of funds. You need to estimate the timing in terms of when, the period that the funds will be available to you or to the business. So it is very important. Let me state here that for every fund that is injected into the business, there is what we call cost of capital or cost of borrowing. Some people call it finance cost. Be it the funds you have borrowed from NISA Microfinance Bank or any lending institution, there are attendant cost of capital, which we refer to as interest on borrowing. So for you to keep that interest at its barest minimum, you need to estimate when the funds is immediately required, so that you don't take up funds, you don't take up loans and begin to bear interest charges on it when you do not require or need that fund. So estimating the timing of the fund is very essential, and that is what financial planning seeks to address. Also, estimating the sources of the funds is another objective of financial planning. The sources in terms of where the funds will be gotten from. You need to also address that issue. Like I said earlier, most of us have already identified the sources of our funding, which is NISA Microfinance Bank, because we have high expectations that NISA Microfinance Bank should be able to disburse this loan at the end of this training, and all the necessary preparations have been taken into consideration. So where the funds should be gotten from or generated is also very important. Then thirdly, generating a capital structure for the business is another reason why financial planning is so important. What do we mean by capital structure? Capital structure is dividing or segregating the total fund injection into your business between what we call equity and debt. So every fund injection into your business will comprise either equity or debt. Equity is a fund contribution by the owners of the business. Take, for instance, any amount that is contributed by you, the shareholder, you, the owners of the company, that amount we refer to it as equity. So if you bring out 5 million naira to plug or to inject into the business that you are proposing to go into, that 5 million, because it has been contributed by you, the owner of the business, we call that amount equity. While any amount that is borrowed or taken as a loan, just like the amount you are proposing to take from NISA Microfinance Bank, will be referred to as debt, a liability, in other words. So every fund injected into a business is either made up of equity or debt. So when we look at generating capital structure, we're trying to look at the proportion of equity to debt among your total fund injected into the business. Capital structure is very important, such that you will ensure that your business does not only thrive on debt, that is on borrowing. When a business thrives mainly on borrowing, there are attendant risks to it. The risk is that the business is exposed to risk of takeover, risk of absorption, and risk of liquidation. Because when you owe any lender who has provided you with funding, the risk that the lender may take over the business when there is a default in principal and interest repayment will be there. So in order to control and minimize all of this risk, usually advise that the fund contribution by the owners of the business, that is what we refer to as equity, should always be more than the amount that is being borrowed. So I want to throw this as an advice to you, even as we are waiting upon NISA Microfinance Bank for the disbursement of the loan at the appropriate time. It is also very important that you ensure that the fund contribution by you, the owners of the business, is more than how much you will seek to borrow, in order that you generate an appropriate capital structure healthy for the business. Then fourthly, is avoiding unnecessary funds. This is another objective of financial planning, to ensure that unnecessary funds are not being tied up. Like I said earlier, every fund taken up and injected into a business has attendant cost of capital, cost of borrowing. For you to minimize that cost, you need to be sure that the funds have been taken when you are ready to commence the business activity. Imagine taking up loans from NISA Microfinance Bank when you are not ready to commence the business. You discover that you tend to pay interest charges, finance cost on the loan you have borrowed, and this will impact negatively on your business. So the timing has to be very right, ensuring that you take up the loans when they are needed for injection into the business. Even the cost of capital does not apply on loans only. Likewise, equity, the fund you have injected, even if it is your personal savings that you have injected into your business, there are also costs of capital to it, because that fund you have injected into the business could have been invested elsewhere, maybe into a short-term money market investment to earn your returns. So there are attendant costs of capital, both on equity and on debt. And in order to minimize this cost of capital, you need to be sure that the funds are sourced and injected into the business at the appropriate time, as when the business is about to commence or has commenced operations. So these are some of the objectives of financial planning, the main reasons why entities, individuals, entrepreneurs engage in financial planning activities. We have two types of financial plans: the long-term strategic financial plans and the short-term operating financial plans. Long-term financial plans is also referred to as strategic financial plans. And long-term financial plans consider a number of financial activities, which include: one, proposed fixed asset investments. Proposed fixed asset investments. Two, research and development activities. Any activities that borders on research and development is definitely a long-term strategic financial plans. Marketing and product development. Any activities that border on marketing and product development has to do with long-term strategic financial plans. Also, any activity that borders on capital structure, how a capital structure should be built, it is also referred to as long-term strategic financial plans. Then activities that border on sources of financing, how the funding is to be sourced, those plans are referred to as long-term strategic financial plans. Let me give you an instance. Let me use one of these activities to demonstrate or make you understand clearly why they are referred to as long-term strategic financial plans. Let's look at the first activity, which is proposed fixed asset investment. If you are considering the acquisition of a fixed asset investment, perhaps you are involved into farming and you are considering to acquire fixed assets. One of the fixed assets you may need as a farmer would be tractor, for instance. If you are considering on the acquisition of a tractor, which is an example of a fixed asset, because fixed asset is any asset that is owned by an entity which is used for revenue generation. And such asset is expected to last for more than 1 year. So tractor meets the definition of a fixed asset to a farmer, because the tractor will be used for revenue generation, and the tractor will definitely live beyond 1 accounting year. So imagine trying to buy a tractor and you are faced with some of the decisions that borders on if the tractor should be purchased outrightly, that is, if you have the cash, if you have the liquidity to buy the tractor outrightly by walking up to a vendor or a distributor, make cash payments and the tractor will be supplied to you. That's one of the options. Another option could be purchasing the tractor via what we call hire purchase or finance lease arrangement. So in an attempt to take any of these decisions on how to acquire or purchase this fixed asset investment, we say that the company is engaging in what we refer to as long-term strategic financial plans. Also, research and development activities, activities aimed at developing a product or prototype before production commences in a commercial quantity. These are also referred to as long-term strategic financial plans. So simply put, how do we know if a plan is of a long-term strategic financial plan? A common way of identifying that a plan is of a long-term strategic financial plan is basically the period of the plan. Look at the period of the plan. If the period of the plan spans for a period of 3 years and above, you do know that such plan is a long-term strategic financial plan. But if the period is any time, any duration shorter than 3 years, then such plan is definitely a short-term strategic financial, a short-term operating financial plans. So whenever you see a plan that is meant to address issues of up to 3 years and above, you know that such plan is a long-term strategic financial plans. So these long-term strategic financial plans are generally supported by a series of annual budgets and profit plans. Even as we say that the plans address issues of up to 3 years and above, they are still translated into annual budgets. So it is also critical that the entity must come up with annual budget, and this annual budget, maybe for 5 years, year 1, year 2, year 3, year 4, year 5, annually, and the 5 budgets are consolidated to give what we call long-term strategic financial plans. So remember we said, if a plan is not a long-term strategic financial plans, it is definitely a short-term operating financial plans. So short-term operating financial plans specifies short-term financial actions and the anticipated impact of those actions. And typically they cover a period of 1 to 2 year operating period. Like I said earlier, if a plan addresses issues of 1 to 2 years, definitely that plan is a short-term operating plans. Once a plan covers activities of 3 years and above, then the plan is a long-term strategic financial plans. Take note. So this chapter and the following 3 chapters focus on short-term financial plans. Very critical, short-term financial plans. Examples of short-term financial plans will be plans on the management of trade receivables or debtors. Debtors are those who owe company. If you have debtors, those who buy on credit from you, and you are considering on how to manage those debtors, those plans on management of your debtors will fall under short-term financial plans. Management will come up with activities or plans that trade debtors are to be allowed maybe a maximum of 1 month credit period or 2 month credit period. So all of these border on short-term financial plans because the plans cover just a very short period of time. Do remember that if a plan is not of a long-term strategic financial plans, it is definitely a short-term operating financial plans. And one of the key ways of distinguishing a short-term from a long-term plan is usually the period that they cover. If the period is up to 3 years, it is a long-term strategic financial plan. But once the period is shorter than 3 years, maybe 1 or 2 years, then it is a short-term operating financial plans. So budget, a cash budget is a tool very useful for financial planning. We use cash budget as a very critical tool for planning our finances, our financial activities. And what then is cash budget? Cash budget is a statement of a firm's planned inflows and outflows of cash. So any statement of an entity that clearly itemizes all what the inflows, that's the cash generation of the entity is, the activities that earn the entity cash for a particular period, and all the activities that will result to outflow in terms of cash expenditures from the entity. That statement put together is what we refer to as a cash budget. Like most of us, we do have a cash budget. Before salaries are paid, we already have a cash budget that helps us plan our resources, a cash budget that helps us identify what our revenue or income or cash inflows are, all the possible resources that we're expecting, and all the possible outflows or expenditures that we may incur. So that is what a cash budget is. The same way, this same cash budget is expected to be drawn up by business owners, to be drawn up by entities, by companies. When you have a cash budget, you are planning for the liquidity of the company. So cash budget is used to estimate short-term cash requirements with particular attention to anticipated cash surpluses or shortfalls. So cash budget is meant to reveal to the company, any company, how much in terms of cash is available to the company at a particular period in time. So when you prepare your cash budget, you are simply trying to see how much is available to the company to meet up with short-term debts when they fall due. So your cash budget may either result to a surplus cash budget or a deficit cash budget. A surplus cash budget connotes that all the inflows, all the revenue you have generated for a particular period is greater than all the outflows for that same period. So imagine generating a total cash sales of 10 million for 1 year, and you have spent or paid out a total cash payment of 8 million. You discover that how much you have generated, which is 10 million, is greater than how much you have paid out in terms of 8 million. So you definitely have a surplus of 2 million. So if that happens, we say that your cash budget is in a surplus. And every business owner will always strive to have a surplus cash budget, because when you have cash at hand, be it at hand, be it at bank, it means that you have some margin of comfort or safety that gives you some guarantee, should in case your creditors, your vendors come asking for their funds to be repaid, you can easily dip hands into the surplus that you have to make such payments. But if, on the other hand, the outflow is more than the inflows, it means you have a shortfall or deficit cash budget. Deficit, for instance, your total sales collections for a particular year may be 10 million, but your total expenditure, cash payments paid out already, is 11 million. In this case, you see that your outflow is more than your inflow. Outflow of 11 million is more than your inflow of 10 million you have generated. In this case, it means you have spent more than you have generated. And we say that your cash budget is in a shortfall. So emphasis here is for a rational business investor, businessman or woman, to ensure that the cash budget is always in a surplus. Though this is usually difficult, especially as a startup, but with consistency and prudent management of your resources and expenses, you can guarantee this. The essence here is that whenever we draw up cash budget, we ensure that unbudgeted expenditures are completely omitted or disregarded. Whenever you have your cash budget drawn up, you ensure that you don't engage in extra budgetary expenditure, extra budgetary activity, such that any expenditure that is not budgeted and that is not essential towards earning your income is totally avoided. It's totally avoided. No wonder even at the National Assembly, the Federation, even states, draw up their budget to give them clear-cut definition or guideline how their funds are to be generated and how those funds are to be expended. That's what a cash budget does, even to a business owner. So cash budgets typically are drawn up monthly. You can draw up your cash budget monthly, and from the monthly cash budget, you consolidate it to have a yearly cash budget. That is annual cash budget. Budgeting cycle. Let's look at budgeting cycle. For us to engage in budgeting activities, we have to carry on these cycles, these activities. For you to plan or draw up your budget, these cycles are very essential. Number one on the budgeting cycle is the performance planning. Planning your performances. To plan your performances is to set your goal or objective for the business. So when we say we are performance planning, it means we are setting up the goal or objective for the business for that particular period. That's what performance planning means. And this is the number one activity under the budgeting cycle, to plan our performances, which entails setting up the goals and the objectives of the business for that particular period in time. So after this, we go into providing a frame of reference. A frame of reference is a benchmark. You set up benchmark activities that help you attain the planned performance, activities that help you attain the objectives, activities that help you achieve the goals that has already been set at stage one. So providing a frame of reference. Let me use an example here. Imagine if you are involved in farming and your plan for this farming season is that at the end of the farming season, you want to have a targeted output, maybe 10 tons of maize after the farming season. So that target is your objective. That target is your plan. The fact that you seek to have 10 tons of maize after the farming season, it means you have planned your performance. You have set out the objectives or the goals for that particular period. Then the frame of reference will be setting up benchmarks. Benchmarks such as you have to measure, to take into cognizance a realistic measure by inquiring from those who have farmed maize to find out from them if the benchmark you have set is realistic, by inquiring to know on average how many tons of maize can be harvested from 1 hectare of land. By then, you know if the plan, if the objective you have set is realistic or not. Because sometimes most people set budgets and the budgets tend to be unattainable. We have attainable budgets and unattainable budgets. But for you to have your budgets attained, you have to make sure that the frames of reference are realistic. They are realistic. Somebody may want to say that he or she wants to harvest 10 tons of maize from 1 hectare of land. That is unattainable budget. That is unattainable goal. But when somebody knowing fully that on average, the output per maize on average, if all things go very well, a hectare of land is 2 tons of maize. The person may say, I want to harvest, having planted or cultivated 5 hectares of land, I seek to have 10 tons of maize from the 5 hectares of land I've cultivated. It means that that plan, that objective is an attainable one. So in providing a frame of reference, we have to set up benchmark that makes our goals or objectives attainable. And after that, we go into the implementation proper. We go into implementation. And implementation in this case is engaging in the activity. Like this activity here will be engaging in the farming activity that we have mentioned. And after that, we investigate variations, if there are any. In most cases, budgets tend to differ from the actual results. Budget will differ from actual results. And when that happens, when the budget differs from actual results, we probe into the possible variation. Why was it that we expected 10 tons of maize and we only harvested 7 tons of maize? What were the possible reasons? Those were the investigations that will have to be launched. You carry out such investigations to forestall any ugly incidents that hampered on the attainment of the goal. So, like the instance I give, which is the farming activity, where we have projected that our goal should be 10 tons of maize, and perhaps we harvested 7 tons of maize. Part of the investigation into the variation will be probing to see if farming was done at the right time, probing also or investigating to see if the right farm implements or inputs were used, if the right seedlings were planted, if the right fertilizers were used, and all that. So these are some of the investigations into the variations that will have to be launched. And after that is done, we take corrective action to forestall reoccurrence of the ugly incident that happened. Some of the corrective action, going by our example, will be ensuring that planting is done early enough during the next planting season, ensuring that the right farm implement or input are being used in the next farming season, such as the maize to be planted next farming season if they are of the good breeds, the fertilizers to be used if they are of the good quality and all that. So these are some of the corrective actions that can be taken in order to correct any ugly incident that happened. And let me also state here that the variations the variances can either be favorable or unfavorable. It is favorable if the output is more than what you have initially projected, but it is adverse or unfavorable if the output is lower than what you have projected. So when it is favorable, there is usually no cause for alarm. But when it is adverse or unfavorable, you may have to put in some corrective actions in order to have a favorable budget in your next outing or budgeting cycle. So after this is done, we plan again. Don't forget that budgeting is a continuous process, and once we plan for a particular period, we plan again. We take corrective actions, we plan again. So let's consider strategy analysis. There are 2 types of strategy. Strategy is also referred to as plan. We have long-run plan and short-run plan. Like we said earlier, long-run plan and short-run plan, or long-run, long-term plan and short-term plans. So for us to address a long-run plan, we need to use long-run budget, meaning our budget must address issues or financial estimates for a longer period of time. And we have said the period of time that long-run budget seeks to address is a period over 3 years, a period of 3 years and above. Or if it is for a short budget, if it's for a short-run strategy, we can use the short-run budget or short-term budget, a budget that addresses financial plans and estimates for a period of 1 to 2 years. So depending on what type of strategy or what type of plan that you have and you seek to achieve, you may deploy any of these budgets, either long-run budgets, if you are considering a long-run strategy or long-run plan, a short-term budget, if you are considering to address a short-term plan or strategy, as the case may be. Cycle of money. There's what we call cycle of money. The primary function of finance is the movement of money from lenders to borrowers and back again. What we're trying to say here is that money tends to rotate. Money rotates in and out of business. If you establish the proposed business of yours and you are able to secure the funding from National Microfinance Bank, you discover that the funds will be paid to you. The funds will be credited into your account. It means that the fund has come into your business, into your company. And as the funds are paid to you, you make payment for salaries and wages. You make payment for goods or services being supplied to you by your vendors or your suppliers. The money is paid out. The same money that was credited to you by National Microfinance Bank has found its way out again when you make payment for goods or services, either to employers, either to suppliers, vendors, or to your employees. The same money that has been paid out to these vendors, suppliers, and employees will eventually find their way back into the business when you have produced your goods or services and customers make payment for these goods or services. So you see that this money, these funds tend to come in and out of the business, and that's what we refer to as cycle of money. So this is referred to as cycle of money. The primary function of finance, like we said earlier, is the movement of money from lenders to borrowers and then back again. So let's take note that money tends to revolve. Money revolves around the business, in and out of the business. So let's consider bookkeeping. Let's consider bookkeeping activity. Bookkeeping involves the recording on a daily basis of a company's financial transactions. The act of recording on a daily basis any financial transaction that happens within a company is what we refer to as bookkeeping. For every naira and kobo that passes through the business, either it comes in or it goes out of the business, you record it. You record such transaction. That is what we refer to as bookkeeping. With proper bookkeeping, companies are able to track all information on its books to make key operating, investing, and financing decisions. Bookkeeping is so important, very important, that you need it as business owners in order to track all your transactions, in order to track all information, financial information in your business. And when you maintain your books of account, you are better equipped to take key operating, investing, and financing decisions. Bookkeepers are individuals who manage all financial data for companies. Without bookkeepers, companies will not be aware of their current financial position, as well as the transactions that occur within the company. So it is very important that you engage the services of bookkeeper. But if you cannot afford the services of a bookkeeper or an account clerk to help you maintain your financial records, to keep your books of account, then there are ways you can maintain these books individually. There are ways you can maintain it personally. So before the end of this training session, I will show you how to maintain your books of accounts. I'll show you how to maintain your financial records, even as non-accountants. So here are the importance of bookkeeping. This is the reason why companies, entities indulge in bookkeeping activities. Number one is to provide a reliable measure of a company's performance. When a company maintains its financial record, the company you're able to tell if the company is progressing or not, if there has been improvement from what the financial records were last year or the prior year and what it is in the current year. That is what bookkeeping does. You're able to assess the strengths and weaknesses in terms of the company's financial operations. That is number one importance of bookkeeping. Secondly, bookkeeping provides information for strategic decision. Once a company maintains its books of accounts, the company is able to take key strategic decisions. For instance, you are involved in farming, and the farming activities, you have two operating segments. One of the operating segments allows you to farm, to cultivate crops, maybe maize. One of the segments you cultivate maize, and the other segment, the second segment, you farm animal, maybe goats. So because you have or you maintain adequate books of accounts, your bookkeeping is intact. You're able to take key strategic decisions by assessing at the end of every farming season how well each of these two segments have performed. You're able to assess which of the segments is bringing more returns than the other. So when you maintain books of accounts, you may be able to reveal that probably the crop cultivation has not brought in enough return than the animal cultivation. Then you can take key strategic decisions such as discontinuing the crop cultivation and channeling all energy and resources into the animal cultivation or animal rearing. So that is what bookkeeping does, providing information for strategic decision making. Thirdly, it provides a benchmark for revenue and income goals. Provides benchmark for revenue and income goals. When you have your books of account in place, you're able to identify your revenue earning activities, your income earning activities, and you rigorously pursue them. Fourthly, fulfillment of legal and tax obligations. You have adequate books of accounts, you're able to fulfill or comply with legal and tax obligations. In this part of the world, Nigeria, most companies, most SMEs, small and medium enterprises, maintain their financial records simply because they want to comply with tax laws. Simply they want to file their tax returns. A greater proportion of companies in Nigeria, small companies in Nigeria, maintain their financial records because they want to comply with tax obligations. And this shouldn't be so. Aside tax compliance, you can maintain your financial records in order that you take key and strategic informed decisions. So we've also seen situations where companies were coerced to paying taxes even when they are not liable. Why? Because there were no financial records in place. No books were maintained by those companies. Fifthly, bookkeeping provides stewardship to investors. When you maintain your books of accounts, managers are able to provide accountability function to their investors. In modern day business, you discover that the managers, those who are entrusted with the day-to-day administration and running of the business, tend to differ from the investors, the owners of the business. So the only way that the managers can provide accountability function to the investors is by maintaining their books of accounts, by providing adequate records, adequate financial records. And lastly, proper management of cash flows. When accounts are maintained, when books of accounts are maintained, financial records are documented, you're able to properly manage your cash flows. You're able to manage the inflows and outflow of your financial records. So these are some of the importance of bookkeeping, the main reasons why companies, individuals, entrepreneurs, and business owners indulge in financial record keeping. Let's look at accounting basis. There are basically two bases of accounting. And when we talk of accounting basis, we are referring to the time period transactions are to be recorded, the time frame that accounting transactions are to be recorded. When a transaction happens in your business, when are you to make? Should it be when you have received income or revenue as it relates to that transaction? or should the transaction has occurred even as payment is yet to be received or made. So this is what we refer to as accounting basis. There are two types of accounting basis: the cash basis of accounting and the accrual basis of accounting. The cash basis of accounting records all accounting transactions cash basis of accounting. The company records all its transactions when there is inflow or outflow of cash. So emphasis here is on movement cash. Whenever there is inflow or outflow of cash, the company will record its transaction. Let me give you an instance. If customers buy goods from you, your customers buy goods from you, and the customer promise to make payment in 1 month's time. The customer is promising to make payment in 1 month's time. For the fact that you use the cash basis of accounting, you have adopted the cash basis of accounting, you cannot record that transaction, the sales transaction in your books until that amount is eventually received by customers in 1 month's time. That's why it's called cash basis of accounting. Emphasis is on cash movement. So it is only when the cash has been received in a month's time that that particular sales transaction can be documented in your books. That's what bookkeeping does. That's what cash basis of accounting does. The same thing applies. If you make purchases from your vendor, from your supplier, and your supplier, you have promised to make payment to that supplier in 2 weeks' time. For the fact that you have not made that payment immediately the goods were delivered to you, you will not record that financial transactions. You will rather wait until 2 weeks' time when you make payment to your supplier before you can record that particular accounting transaction. That is what the cash basis of accounting entails, meaning that transactions are recorded only when cash is received or paid. The moment cash is received or paid, you record the transaction. But if cash has not exchanged hands, if cash has not come into the business or left the business, you don't record any financial transaction. That's the cash basis. Then the other type of accounting basis is the accrual basis. This takes the opposite turn of the cash basis. Under the accrual basis, accounting transactions are recorded when they occur, even if cash is not received or paid. So under the accrual basis, emphasis is on the occurrence of the accounting transactions, whether or not payment has been received or not. So for instance, when you use the accrual basis of accounting, you make purchases from a customer and you are promising to make payments to this customer who has supplied you with those goods in 2 weeks' time. Even though payment will be made in 2 weeks' time, for the fact that you use accrual basis of accounting, the transaction has occurred because the supplier would have delivered those goods to you. So since the transaction has occurred, being the accrual basis, that accounting transaction has to be documented, has to be recorded. This is quite different from the cash basis, where we have to basically rely on the movement of cash. So here is an example before us. Here's an example before us. You purchased 100 units of a product and you will pay for it next month. You have made purchases of 100 units of a product and payment will be made for it next month. Under the cash basis of accounting, because payment is due next month, no accounting transactions will be recorded. Don't record any accounting transaction because cash has not exchanged hands. Cash has not left your business. But if it is the accrual basis of accounting that you use, that you have adopted, for the fact that the transaction has occurred, For the fact that the transaction has occurred, even though payment is yet to be made, that particular transaction will have to be recorded through what we call accounts payable. So let me state here that a company can use one of the two, either the cash basis of accounting or accrual basis of accounting. The company can use one among the two. Anyone that is adopted will have to be applied consistently. In accounting, you're only permitted to use one among the two. You can choose to use the cash basis or you use the accrual basis. And anyone that you use, you apply it consistently. For instance, if you decide to use the cash basis of accounting in recording all your transactions, it's expected that having commenced the cash basis of accounting in this year, 2021, subsequent years to come, 2022, 2023, and so on, you will continue to use the cash basis of accounting. If, on the other hand, you adopt the accrual basis of accounting, it's also expected that the accrual basis of accounting will keep to apply throughout the useful life of your business. So take note. So methods of bookkeeping, here we have two methods of bookkeeping, the single entry bookkeeping method and the double entry bookkeeping method. Not to forget that towards the beginning of this session, I told us that at the end of this training session, even non-accountants will be taught how to maintain their financial records. For those who cannot immediately afford the services of bookkeepers or account clerks, we'll show you how to maintain your financial records. So the single entry bookkeeping will appeal mostly to non-accountants. What is single entry bookkeeping? Single entry bookkeeping is a straightforward method where one entry is made for each transaction in the books. When a company uses the single entry bookkeeping, it means only one entry is made for each transaction in the books. So how do you use the single entry bookkeeping? You can use the single entry bookkeeping by providing a hardcover notebook for your business, for your financial transactions. You have a hardcover notebook where you record all financial transactions that happen within the business. That is a record keeping in its own, in a simple and most straightforward manner. You can also have what we call analysis column cash book. Analysis column cash book is sold in the bookshops. You can get it from the bookshops. The analysis column cash book has various columns, just like the name suggests. It has various columns. You see various columns. So each of these columns, you can decide by labeling them. This column, I want to record all salaries and wages I make, the payments. This other column, I want to record all repairs and maintenance I make. The other third column, I want to record all utilities, that's NEPA bill, water bill, and the rest. The other column, you want to record all transportation costs, so on and so forth. So by designing the several columns, you record each of the transactions in the appropriate column as they apply. That is a single entry bookkeeping method that you can adopt. And most people have used it and it worked for them. You can also have another column that you record all your sales, all your income that flows into the business. So this is a single entry bookkeeping method. Another single entry bookkeeping method that you can adopt even as non-accountant is by always populating your check stubs. The check stub, for those of you who know what we refer to as check stubs, the small portion of the check leaf that is left in the check booklet. Whenever you issue a check to a vendor, you fill the other small portion, the check leaf on the check stub. You fill it with the appropriate information, and the amount, such that when the time is right, a qualified accountant or auditor can use the check stub to generate appropriate financial report for you. So these are simplified ways of maintaining your books of accounts. So even as non-accountants, this method, the single entry bookkeeping method, is so easy, very easy to adopt, very easy to use, very easy to understand. Anyone can adopt the single entry bookkeeping method in keeping his or her financial records. Then the other one is the double entry bookkeeping. Double entry bookkeeping. The double entry bookkeeping is more robust. It follows the principle that every transaction affects at least 2 accounts, and they are recorded as debits and credits. Every transaction that happens has what we call debit and credit entries. For example, if you sell a bag of cowpea for 20,000 naira, cowpea is beans. If you sell a bag of beans for 20,000 naira, you see it is only one transaction, which is a sales transaction. But you can see from the screen, the entries are 2, the debit entry and the credit entry. One account will have to be debited and another account credited. This is what we mean by double entry bookkeeping. In other words, for every single transaction that happens, there's usually a corresponding debit and credit entry to that effect. So for you to use the double entry bookkeeping, you must have some accounting knowledge, must have accounting background. You should be able even to employ a bookkeeper or an account clerk who has some knowledge of accounting in order that they can use this double entry bookkeeping. But if you wish to maintain the books of accounts yourself as non-accountants, don't forget you can always stick to the single entry bookkeeping method. So accounting systems, that's what we call accounting systems. Accounting systems are designed to collect documents and report on financial transactions affecting business. So any measure, any structure that you put in place, be it manual or computerized, that helps you collect, document, and report all your financial transactions as they affect your business is what we refer to as accounting systems. Even the process of designing the analysis column cash book to help you record all your financial transactions in the appropriate column as they occur. It means you have designed an accounting system. So accounting systems can either be manual accounting system or computerized accounting system. Accounting system is said to be manual if it is being processed by hand. For instance, the act of recording your accounting transactions using hand, recording it on the analysis column cash book, recording it with hand on the hardcover notebook that we have mentioned earlier, populating it on the check stubs whenever check payment is made. These are all manual accounting systems. Reason being that all of these accounting transactions are being processed by hands. You do it manually, you process it by hands. So if an accounting system is not manual, it is definitely a computerized accounting system. A computerized accounting system ensures that financial transaction is recorded by entering it into a computer. So when an entity uses a computerized accounting system, it means the entity relies on the use of computer in order to maintain its financial records. In this case, you may use some accounting software, accounting packages, such as QuickBooks, Peachtree, Tally, and all that. These are accounting accounting softwares that can be computerized to work alongside with your computer. You can also use Excel. So by using Excel, you cannot use Excel without a computer, and that makes it a computerized accounting system as well. There's usually a notion or an assumption by most people that once an accounting system is a computerized one, that such accounting system must be free from error. That is not correct. The fact that an entity uses a computerized accounting system does not mean that the accounting information will have to be always correct. That is what we call GIGO, garbage in, garbage out. You must understand that this computer, anything we feed into the computer, any data that is fed into the computer will tend to be correct if they have been properly fed into the computer. But if it is wrongly fed into the system, into the computer, the outputs that the computer will generate will also be inaccurate or incorrect. This is what we refer to as GIGO, garbage in, garbage out. So once a wrong information is fed into a computer system, the computer system tends to generate a wrong financial report. But once the right information, accurate information has been fed into the system, the right or accurate financial report will also be generated. So that's what we mean by garbage in, garbage out. Still on accounting system, there's what we call generally accepted accounting principles, GAAP. All accountants use the same set of rules to prepare financial reports. All accountants who want to prepare reports, financial reports for companies must follow the same set of rules. And this set of rules are being issued by Financial Reporting Council of Nigeria, FRCN, responsible for the issuance of these rules to be adopted by all financial accountants, all reporting accountants. Financial reports summarize information about the financial status of a business. You see, let me state here that the end product of our bookkeeping activities is to help us generate or produce what we call financial reports. We are discussing record keeping, bookkeeping, but the bookkeeping activity we seek to maintain is such that after the end of the bookkeeping, at the end of a particular period, when the books of account have been maintained, we can then produce financial reports thereof. So the financial report is the information that we produce, the accounts, the financial reports, accounts that we produce from the bookkeeping activities. And in producing these financial reports, emphasis must be placed on the GAAP, generally accepted accounting principles, issued by FRCN, Financial Reporting Council of Nigeria. It is so important that every accountant, every preparer of financial information or financial report must pay attention to the guidelines of these generally accepted accounting principles. Let me give you an instance why it is so important to pay attention to this gap. Most business owners, especially in this part of the world, Nigeria, some SME owners don't like to pay taxes. Yes, that's the truth. That's a fact. Most business owners, SMEs, don't like to pay taxes, maybe because of the governance and economic situation of the country. And because they don't want to pay taxes, because business owners don't want to pay taxes, they want to prepare the account in a manner that will result to little or no profit for the year. And when they have little or no profit for the year, they also have little or no tax liabilities for that same period. So in order to prevent or guard against all of these window dressing and creative accounting, that is why the FRCN, Financial Reporting Council of Nigeria, has come up with this gap, and all accountants are expected to comply. Some managers, their reward is based on incentive, especially those in the banking system. Some managers, they are promised by the investors that out of the profit for the particular period, they have a certain percentage share of profit. So you can imagine what the managers are likely to do in order to earn the reward or the incentive. The managers will ensure that the profit reported for the period is huge enough in order that they enjoy the incentive being promised to them. So in order to guide against this window dressing, creative accounting, that is why the FRCN has issued this GAP, Generally Accepted Accounting Principle, such that all accountants, all qualified auditors preparing financial reports of a company must abide by this generally accepted accounting principle. And this will go a long way to minimize the whole effect of window dressing and creative accounting, the whole effect of manipulating financial reports. So ladies and gentlemen, let's remember that whenever we talk of accounting, accounting is a language of business because it is so fundamental to the communication of financial information. Accounting is often called the language of business. We call accounting the language of business because we use it to communicate. We use it to communicate financial information to all parties involved. So we have two broad categories of accounting reports. We have the financial accounts and management accounts. Financial account differs from management account. Financial account focuses on reporting information to external users. So simply put, financial accounts are those accounts we prepare for external users' needs. I will tell us who the external users are any moment from now. I'll tell us who constitute external users and who constitute internal users. So when accounting reports are prepared because external users are so interested in those accounts, because external users will make use of those accounts, we say those accounting reports is referred to as financial accounts. We call it financial accounts. So any account that is prepared to report information to external users is referred to as financial accounts. But if, on the other hand, these accounts are prepared to focus on reporting information to management, often referred to as accounting for internal users of accounting information. Internal users are those who are members of the company, those who are involved in the day-to-day administration and oversight of the company. So any account that is prepared for internal users' need for members of the company, that account is referred to as management account. So let's note the difference between the two. That financial accounts is prepared for external users' need, while management account is prepared for internal users' need. How is these two accounts different? Financial account, because it is usually served to external users, those who are not members of the company. In most cases, before these financial accounts are sent out, we require the auditor, external auditors, qualified auditors, to express what we call opinion on it. External auditor will have to express opinion because this financial account will be served to external users. But for the management account, because it is usually for internal management decision making, it is for use within members of the company and those involved in the day-to-day administration of the business. Usually, we don't require external auditors reports on them. So that is the major difference between the financial account and management account. So here are examples of external users of accounting reports. External users are individuals outside the business who have an interest in the business. External users are individuals outside the business who have interest in the business, and they include: one, governments. Governments, A government agency may be interested in your financial reports. A government agency in this case, for example, the tax authority, FIRS, may be interested in your financial report. FCT-IRS, FCT Inland Revenue Service, may also be interested in your financial reports because of your tax compliance. If you're also involved in some businesses that are considered to be regulated businesses, example, insurance business, you may need to submit your financial report, your accounting report to NICOM, being the regulatory government agency, National Insurance Commission. If you are involved in pension business in Nigeria, you may need to submit your financial report to National Pension Commission. So these are government agencies who are considered as external users of accounting reports. Another example of external user is the general public. The general public may also be interested in your financial statement, especially if you have your shares trading on the floor of the Nigerian Stock Exchange. That's for the PLCs. Once you have gone public, you are a PLC, just like GT Bank PLC, Zenith Bank PLC, Dangote PLC, Julius Berger PLC. All of these PLCs, because they are public companies, their financial reports will have to be made available to the general public. Another external user is civil societies. Civil societies may be interested in one way or the other in your financial reports. And the other type of external user is the lenders. Lenders are those who provide you with funding for your business. So your lenders may be interested in seeing what your accounting report looks like. A lender in this case is the NISA Microfinance Bank. If NISA Microfinance Bank successfully provides you with the necessary funding for you to kickstart the business, NISA Microfinance may at point in time call for your accounting reports. So these are examples of external users of accounting reports. Let's consider those who are internal users of accounting reports. Internal users are individuals inside the business. Examples of internal users of accounting reports are shareholders. Shareholders are owners of the business. Just like you listening to me, if you successfully kickstart that your business, you become a shareholder of the business. Everybody who has contributed for the business to kickstart, who has contributed for the business to commence operation, they are referred to as shareholders. So the shareholders are individuals inside the business. Managers also are examples of internal users. Managers, those who are entrusted with the day-to-day administration and running of the business, they form example of internal users. Employees also, employees of a company are also examples of internal users. So these are some of the examples of both external users and internal users of accounting reports. So here are primary accounting reports. Don't forget, we said the whole essence of bookkeeping, the whole essence of maintaining our books of account is to enable us prepare these accounting reports thereof. So after the bookkeeping activities, it's expected that we hand over the bookkeeping records we have maintained to a qualified accountant or to an auditor who will in turn generate or prepare these primary accounting reports. And the primary accounting reports to be generated from your bookkeeping activities are 1, balance sheet, 2, income statement, and thirdly, cash flow statement. Balance sheet is a statement that shows what a company has and what the company owes the outsiders. So a balance sheet is usually a statement that shows the financial position of a company. And balance sheet is usually made up of assets, liabilities, and equities. Liabilities are made up of assets, liabilities, and equities. So there's what we call balance sheet equation. The balance sheet equation states that liabilities and equities put together must equal the total value of a company's assets. So assets are resources owned by a company, while liabilities and equities are resources being borrowed by the company, the same company. So if a company has a total value of 10 million for each asset, for instance, a company's asset is 10 million, it definitely means that the liabilities and equities of the same company put together must equal the same 10 million. What that means is that for the company to have bought an asset of 10 million, is either part of that 10 million has been contributed by owners of the business, that is equity, or part of it has been borrowed, that is a liability. So in most cases, when we have any of these two variables, we can always work out what the third variable should be. For instance, if you are given the value of assets and you're also given the value of equity, imagine the value of asset being 10 million, like we said, and the value of equity is given to be 6 million. So since equity and liability, when added together, must equal to the value of the asset, therefore means for a company to have asset of 10 million and 6 million has been contributed by the owners of the business, the balance of the 4 million to make up the value of the asset would have come through what we call a liability. So in any case, we can always say asset minus equity to give us the value of liability, or asset minus liability to give us the value of equity. Or if we want the value of asset, we can sum of the liability balance and equity balance. So this is what we refer to as balance sheet equation. Then the other type of primary accounting report is the income statement. Income statement is a statement that is prepared to show how much in terms of profitability that a company has made. So profitability or loss, a company can record either profit or loss in a particular period. So income statement is prepared by aggregating all the sales and deducting all the expenses. That will leave us with either profit or loss. It is a loss if the expenditures are more than the total sales for the particular period. So I'll show us what an income statement, a format of an income statement looks like, as well as balance sheet. Cash flow statement. Cash flow statement is a statement that is prepared in order to show the liquidity position of a company. Whenever a company wants to know its liquidity position, it's most advisable that the company should prepare cash flow statements. So for a cash flow statement, the company generally prepare all its aggregated inflows of cash, then minus all cash outflow. Cash inflow is the total cash collection, cash outflow, total cash payment. So when the total cash inflow, cash generated, exceeds the total cash outflow, it means that the company has a positive or a surplus cash flow. But when the cash outflow is greater than the total cash inflow, it means that the company has spent more cash than it has generated. And this will leave the company with a deficit cash flow statement. So emphasis, the main reason why cash flow is prepared is to assess the liquidity position of a company. And liquidity is so crucial, so critical, because it measures the ability of a company to make or meet up with short-term debts when the need arises. Ability of a company to meet up with short-term debt when the need arises. So must not mistake liquidity for profitability. If you want to assess profitability of a company, we use the income statement. But once we want to know the liquidity position in terms of how much naira and kobo that is left with the company at a particular period, is expected that we prepare the cash flow statement to show us how liquid the company is. So this depicts the balance sheet equation that we talked about, where we said assets must equal the value of liability and equity together. So when we add liability and equity together, it's expected to give us the value of our total assets. So if we have total asset of 10 million, it means the left column, left section of this balance sheet, which is liability and equity put together, must also give us the 10 million. So income statements is basically prepared by aggregating all revenue, deducting expenses, thereby leaving us with either profit or loss. So let's look at the typical format of a balance sheet. The typical format of a balance sheet. If you observe carefully, you notice that this balance sheet has two sections, the left-hand section and the right-hand section. The left-hand section accounts for all the assets of the company, all assets of the company. What is an asset? An asset is resources owned and controlled by an entity. So any resources that is being owned and controlled by this entity will have to come under the asset section. And the asset section is also subdivided into two, current assets and non-current assets. Let's start from the current assets. Current assets are resources owned and controlled by an entity, which can be easily translated to cash within 12 months. So whatever asset, whatever item, whatever property that belongs to the owners of this business, which can be translated or converted to cash within the next 12 months, they are to be grouped under the current assets. Example, cash and cash equivalents. Cash and cash equivalents. For the fact that this is cash and cash equivalent, it means it is in its liquid form. It's already in cash. There's no further point of conversion. It comes under the current asset. Account receivables. Account receivables are debtors. Those who have bought on credit from this company, as such, they are owing this company their account receivables. So because these customers have bought on credit from this company, we expect that such credit balances will be paid or settled within the next 12 months. And that's why they are categorized as current assets. Inventories. Inventories are items of a company held for the purpose of resale. Whenever a company has an asset that it intends to sell, that item is treated as inventory. So because this inventory is held for the purpose of resale, the sale of that item is expected to happen within the next 12 months, and as such, it is classified as current assets. Prepaid expenses, when a company pays for expenses in advance. Example, the company may pay for 2 years' rent, and at the end of year one, when the company is preparing its accounts, the rent that is for year 2, which has not been enjoyed by the company, will have to come in as prepaid expenses. It is also a current asset. Investment also that have maturity within 12 months. If a company has any investment, maybe fixed deposits, short-term investment in money markets that is due to mature within the next 12 months, they are also categorized as current assets. They are categorized. So simply know that all current asset items are items that can be converted to cash within the next 12 months. So anything that belongs to you, the business owner, anything that belongs to a company, which can easily be converted to cash within the next 12 months, they come under the current assets. Now let's shift focus from the current asset to the non-current assets. Non-current asset takes the opposite turn of the current assets. While the current assets are expected to be converted to cash within 12 months, the non-current assets cannot be converted to cash within the next 12 months. Examples of the non-current assets which may not be converted to cash within the next 12 months are property, plant, and equipment, which is land. When a company has land, which it uses for generation of its revenue, land usually is expected to last or live beyond one accounting year, to live beyond 12 months. So land is an example of non-current assets. Building also is an example of non-current assets because building will live for more than 12 months, more than 1 year. Equipment, plant and machinery, furniture and fitting, motor vehicles, these are examples of property, plant, and equipment that will live beyond 1 accounting year. Then the other type of non-current asset is what we call intangible assets. Intangible assets are identifiable non-monetary items without physical substance. So simply put, any item that belongs to a company which the company uses to generate revenue or income that cannot be seen, felt, or touched. That is a good example of an intangible asset. Example of an intangible asset is license. Perhaps you have a license as a business owner, and that license helps you to generate revenue. Imagine if you have a fishing license, a license that enables you to fish for a particular river. That license, you cannot see it, you cannot feel it, you cannot touch it, but it helps you in one way or the other to do what? To earn revenue. That is a clear example of an intangible asset. Intangible assets. So these are the compositions of assets. And we have said that assets can be categorized between current assets and non-current assets. They will move attention to the right-hand section, which is liabilities and equities. Under the liabilities and equities, we have for the liabilities, liabilities are also subdivided into two: current liabilities and non-current liabilities. Let's look at the current liabilities. Whenever we talk of liabilities, we are talking of a company's indebtedness to outsiders. When a company owes outsiders, we call it liability. The company is owing outsiders, we call it liability. So current liabilities are those indebtedness of a company which is expected to be settled within the next 12 months. Example is accounts payable. Accounts payable, when a company buys on credit from its vendors and the company is now owing the vendors or the suppliers, that is an example of accounts payable. So these accounts are expected to be settled within the next 12 months. It's expected that you settle your suppliers, your vendors within the next 12 months. And that's why they are categorized under the current liabilities. Note payables. Perhaps you have loans you have taken, which is due for settlement within the next 12 months. They come under the current liabilities. They come under the current liabilities. Accrued expenses. Maybe you have enjoyed some services which you are yet to settle, which you are yet to pay for. Example, maybe you are owing salaries or wages or taxes. You have enjoyed the services, but you have not paid for it. They will all come under accrued expenses. It's a liability to you. It's indebtedness to you. And such indebtedness must be settled within the next 12 months. That's why it's categorized under current liabilities, because they are due for settlement within the next 12 months. Deferred revenue. Maybe you have earned some revenue, you have earned some income, but you have not discharged your own part of the responsibility. Maybe a customer has paid you to supply an item. You have received payment, but you have not supplied the goods or the services. We call that deferred revenue. It's a liability which you have to settle or pay back within the next 12 months. It's either you pay back the amount or you supply the goods or services in question. So that's why they are categorized under current liabilities. Now, the other type of liability is the non-current liability. So if a liability is not current, it is definitely non-current liability. Why we say that current liabilities are meant to be settled or paid back to those who have provided the funding or those who have provided the services within 12 months, the non-current liabilities, they are back for a period over 12 months, over 1 year. You pay back in a period over 1 year. Example of non-current liability is the NISA Microfinance Bank loan. So if you get this loan from NISA Microfinance Bank, for the fact that NISA Microfinance Bank expects you to pay back this loan amount for a period over 1 year, that makes it comes under the non-current liability. But if the loan you are obtaining from NISA Microfinance Bank, you will be expected to pay back that loan within the next 12 months, that's within 1 year. It means that loan will be categorized under the current liability. But since this loan will be paid back for a period in excess of 1 year, you categorize it under the non-current liability, NISA Microfinance loan. Then shareholders' equity. Shareholders' equity are all balances belonging to owners of the business. Example is ordinary share capital. Ordinary share capital. Ordinary share capital, point of incorporating the business, all the shareholders subscribe to share capital. So those share capitals are presented under the equity section. Retained earnings, all accumulated profit or losses over the years that the business has been in operation, will also come under the retained earning. That's the shareholders' equity. So all of these put together will give us the shareholders' fund. So I want you to observe carefully that the total of the left section and the right section are equal. Notice that assets, the total value of the assets on the left-hand section, and the total value of the equities and liabilities are all equal. And this is what we mean by for a company's account to be balanced, your balance sheet has to be equal. The debit and the credit has to be equal. The left-hand section and the right-hand section has to be equal. Then income statements. Income statement. Remember, we said income statement is basically to assess the profitability level of a company. So this is how a typical format of income statements. For the income statement, we aggregate all sales or all revenue earning activity, all revenue earning activities, all the revenue earning activities, just like what we have before us. You can see part of the sales earning activities of this company is client service revenue. They have earned revenue from providing services to clients. Sale of books also. Professional consultation. These are all revenue earning activity. So imagine if you're also involved in a farming activity and you want to prepare your account. Perhaps you have cultivated several crops during the farming season or during the year. It's also expected that when you prepare your income statement, you should provide all the revenue from the various farm activities. Maybe you cultivated yam, you cultivated maize, you cultivated beans. It's expected that when you prepare your income statement, you should show sales of beans, sales income from beans, sales income from yam, sales income from maize, so on and so forth. It's expected that they should be broken down. Then the expenditures, you also itemize them depending on the expenditures that are peculiar to your business. You aggregate them. So by the time we aggregate all of these expenditure, we minus the total expenditure from expenses. It's expected that we'll have profits or loss before tax, after which we make provision for income tax. Then we have profit after tax for the year. I want us to observe that this income statement that we have projected has 2 years. If you notice, we have the income statement here has 2 years. 2004, which is the current year, and 2003, which is the comparative year. It is so crucial that when you prepare income statements for the current year, which is 2004 in this instance, you must also include the prior year figures, which is 2003. The reason for inclusion of prior year income statements is to help users of financial statements make and take adequate informed decisions. So whoever that is studying or reviewing this income statement will want to see what income, what revenue is for the current year, 2004, and what revenue was in the last year, 2003. The person will want to check if revenue has increased from what it was 2003 to what it is now. The person reviewing this account will also want to check if profit has grown from what it was last year, 2003, to what it is this year, 2004. So that is the whole essence of including the comparative figure, the prior year figures, in order to enable users of financial information make and take adequate informed decisions. So here are components of accounts. All accounts prepared. All accounts being prepared must have any of these components. Every account you prepare, be it balance sheets, be it income statements, they must have any of these 5 components. The first 3 components, assets, liability, and equity, they are used for the preparation of balance sheets. Asset, liability, equity, useful for the preparation of balance sheets, while the last 2, revenue and expenses, are used for the preparation of income statements. Take note. So the last 2, revenue and expenditure, being used for the preparation of income statements. Take note. So we are saying here that a business can have anywhere from a dozen to several thousand accounts, with each one being one of the 5 types. So no matter the business that you prepare the account for, that you maintain their books for, they must have their transaction will fall into any of these 5. So let me take you through an example. Example 1, if a company buys motor vehicle, maybe perhaps you are involved into farming and you buy a tractor for your farming activity, the purchase of that tractor falls under what we call assets. So it comes under the components, the first component of this account, which is assets, the tractor. Second example, if you sell your goods, your outputs, you sell them, such sales will come under revenue, which is second to last, the 4th item on the list, revenue. If you pay salaries to your workers, such salaries will come under expenses, which is the last item on the list. So no matter the transactions, whatever it is, they fall between any of these 5 transactions. If you borrow loan from NISA Microfinance Bank, such loan will fall under liability, which is the second on the list. It's an indebtedness, liability. So no matter the transaction, whatever it is, it must fall within any of these 5 components of accounts. Take note. Accounting. Let's look at accounting briefly as we round up. Accounting is the process of recording business activities such that changes are made to the account. So the whole process of recording business activities tend to change. That's what we refer to as accounting. These include sales of products. When a product is sold and is being accounted for, the sales balances will change. The sales balance will do what? Will change. It will increase. When revenue from services are earned, perhaps you render services and you earn revenue from such rendition of service, it means your revenue balance will also change when you account for it. When you buy products or services, such purchases, your purchases account will also change when you account for it. When you incur other expenses, your expenses account will also change. When you charge depreciation of your fixed asset, your expenses account, your depreciation account, the balances will also change. So whenever you make any transaction and you account for it by posting it into the appropriate account, we are saying that the account balances will change, either go up or come down. So when any of these and other business activities are recorded, accounts change in value. The account balance change in value. So when you make sales, for instance, you notice that your sales value, your sales accounts will increase in value. That's what we mean by accounting. You account for it, your balances will increase. So some accounts either increase or decrease depending on the nature of the transactions. Double entry. For any business transaction that happens, two or more accounts are affected. This is a give and take of equal naira amounts. Any transaction that happens, whatever the transaction is, two entries are made, like we demonstrated earlier when we were looking at the methods of bookkeeping, which we said the double entry bookkeeping method. So whenever a transaction is made, a particular account balance is debited while another account is credited. But I have said it here that understanding is that most of us may not have accounting background, and as such, we don't want to dwell our attention on the whole concept of debit and credit. Remember we said, if the debit or credit, if you want to use the debit or credit, you may need to engage the services of a bookkeeper or an account clerk to help you maintain these accounts. But if you want to maintain the records personally, maybe because you cannot afford the services of a bookkeeper or an account clerk, you can stick to the single entry bookkeeping method. By so doing, you don't need to bother yourself with which of the accounts should be debited and which should be credited. So whenever an account, some accounts by debiting it, you increase their value, while some by crediting it, you reduce their value. So depending on which one it is. Now let me quickly show you this. You see, these components of accounts, 5 components of accounts, the assets, liabilities, equity, revenue, and expenses, they have what they call their default account balances. Some of them have default debit balance, while some have default credit balance. The first and the last, which is asset and expense on the list among the 5, they have default debit balance. By default, they are naturally debited if we want their balances to go up or to increase. So if we want, for instance, our assets to increase in value, what are the activities that will cause it? Maybe a company buys office equipment, maybe laptop. The asset account will increase in value because ordinarily it has a default debit balance. So in other words, we are saying due to the purchase of the laptop, it will increase. But if on the other hand, the asset account is credited, it means the value will reduce. For instance, a laptop is being sold or any office equipment is being sold. This asset account will have to be credited so that the balance can be reduced, the balance can drop down. The same thing applies to expenses. When we want our expenses to increase, we debit it. When we want our expenses to reduce, we credit it. So assets and expenses have what we call default debit balances, while liability, equity, and revenue, they have default credit balances. So because liabilities, equity, and revenue have default credit balances, if we want their values to increase, we will credit the particular account. Take, for instance, when you get the loan from NISA Microfinance Bank, being a liability, loan is a liability, which is the second on the list. And all liabilities have a credit default balance. So that loan you are getting from NISA Microfinance Bank will have to be credited to your liability so that your liability grows in value. Then when you make payments, repayment to NISA Microfinance Bank, you want your liability to reduce because you have made payments to reduce your liability. You debit this liability. So not to worry, like I told us, we understand some of us do not have accounting background or knowledge, but emphasis here is on financial planning and bookkeeping. So it's expected that you should be able to plan your finances adequately, bearing in mind that some of the plans you may come across will be long-term strategic financial plans, short-term operating plans. Then we talk about bookkeeping, the act of maintaining our financial records. So, and like we have said here, we have various methods of bookkeeping. We have the single entry bookkeeping method, which we said will appeal mostly to non-accountants, and the double entry bookkeeping, which will require the services of account clerk or those with prior knowledge of accounts in order that they use that particular method. So, ladies and gentlemen, on this note, I want to appreciate you for your audience, and the floor is now open for questions. So the floor is open for question. If you have question, if you have observation, if you have comments, simply notify us by a show of hands. Let's see your hands. You can raise your hands up so that we can allow you. We can take questions or comments, observations from you, or you go to the chat section, click on raise hand, click on the raise hands, or you can even send your comments via the chat section. Any question? If there is none, click go into the quiz section. Any questions? Any question? Yes, we can hear you.
The audio is cracking. So I've been cracking. I'm not getting everything clearly. Though I didn't come in at schedule, but it's cracking seriously.
I'm sure it's from your network connection. But from here, we can see the strength of your network is really not too strong. But in any case, you can access the YouTube link to replay the session. Yes, you can replay the session at your convenience. Your network is really bad. Yes, you can see it from our end. So bad. So do you have any question for us?
Okay.
Chidozie?
Not really. Maybe not really for now.
All right.
You can hear me.
Okay, no question from Mr. Chidozie.
Yes. Yes.
Okay. So the link to the post-lecture quiz has just been shared on the group platform, the WhatsApp platform. So it's expected that you complete it by providing answers and return 5 minutes. Okay, let's give 7 minutes. We have just 7 minutes to do this. Provide answers. Expected to provide answers. Lecture quiz. That we can the first section for today. Okay, welcome back, everybody. They all send their responses. No response. Okay, none of you have sent your response to the quiz. And this is not good enough. It's not encouraging. We expect your response to the quiz. So even if you have not done that, you still have between now and the next 24 hours to do so. Please expect the quiz from you. So on this note, the first session, the class, the training for the first session will come to an end. So I urge you to hold on for the second section. The second section will commence almost immediately. So don't leave. Don't leave the platform, please. So just hold on for the next presenter, the person of Dr. Che, will come on to take the second session. So on this note, ladies and gentlemen, I want to thank you once again for your audience, for your patience, for your attentiveness, and we'll see you next time. Bye for now, and hold on for the second.